At the Reliance Expert Series today, we have with us Mr. Sunil Singhania, CIO Equity Investments, sharing his views for the last month of the last financial year. Welcome, Mr. Singhania.
Thank you.
The equity markets have witnessed a lot of rally over the last few months. In fact, the indices are near to the all-time high. Do you think this rally is going to sustain?
See, the markets basically reflect what is happening on the economy. So obviously, we have seen, as you mentioned, a good rally. I think it's on the back of one, a very stable global environment, and second, renewed hopes of the Indian economy moving into the next phase of super growth. So I think this new highs are a reflection of what is happening on the economy side. We have had a stable currency. We have had all the macroeconomic indices in our favor. Oil has been quite stable. And on top of that, the various reform process and predominantly the GST, which was in the limbo for quite some time, I think that has also got approved. So it's a reflection of the optimism on the future, and we remain quite optimistic.
So that really gives a very good approach about the market. So now that we have all the major events like the union budget, the US policy, the RBI policy review are right behind us, elections in the key states, which do you think are the main triggers for the market now?
So one thing which has been lacking in the market has been earnings growth over the last 2 years. I think for the first time this quarter we'll start to see overall on a nifty level earnings growth maybe inching up to double digits, led by a couple of sectors, predominantly banks and the metals pack, which has not been performing well but which have on a lower base should do well. Also going forward, some of the sectors which are showing promise obviously are capital goods because of the government push for housing for all, various infrastructure projects being announced and implemented. And you also have the consumption theme picking up again. So backed by both the urban demand post demonetization as well as rural demand because of a great monsoon last year. We have seen the consumption theme also picking up. So I think that should also fire up. The world is a stable place, so hopefully the metal pack and the other sectors should also do well. So we are finally looking at some earnings growth, and that should be the next trigger going forward. Hopefully we will have another good monsoon. So let's see if that happens, then that might be another fuel for fire. And GST, as I mentioned earlier, is looking a reality. So once that gets implemented, it will have the initial hiccups, but that itself can add almost 1% to our GDP. So I think there are quite a few triggers.
So that takes care of the triggers. So for the last 1 month, we've had the mid and the small cap segment. We had an outstanding performance from the mid and the small cap compared to the large cap. Out of the current levels of the market, you think this outstanding performance will sustain? And which do you think, the large, the mid or the small cap are looking very attractive?
So this question we keep on answering every month, every quarter, every year. In a growing economy, the smaller companies will tend to do better over a period of time, but with more volatility. I think the trend should continue going forward. One note of caution: stocks are not cheap on the mid and small cap side. You have to be very stock specific. Just can't chase stocks just because the prices are moving up. But as I mentioned earlier, in a growing economy, there is obviously opportunity for smaller companies to grow faster, and we expect that to continue. So if you have a view of 3-4 years, maybe the mid and the small cap is the space to be in. If you have a shorter view, then you should be at a more stable segment, which is the large cap. In terms of opportunities abound in a growing economy like India. So the financials should continue to do well. As we have communicated earlier, our view is that the savings are going to move from physical assets to financial assets. So life insurance companies, wealth management companies, asset management companies should gain. Some well-managed banks should also perform well. Consumption, again, as a theme, should continue to do well. And select capital goods, including cement, is another theme which we like a lot.
So that takes care of our segments. When we take the global linkages for an outlook of a sector, what is your outlook towards the healthcare and the IT sectors?
So these two sectors obviously have not performed. I think pharma had a great run between 2008-9 to 2015. 16 was not a great year for pharma, and we saw the sector underperform quite significantly. The trend is continuing in the first quarter of 2017. Having said that, I think there are a few things which the investors should note. One is there has been a decent correction in a lot of these stocks. So the stocks now from being overvalued have come to fair value. Second, the intensity of the regulations and the regulatory issues are maybe behind us, and from here on you should start to see more approvals coming in, and even the facilities which were under scrutiny getting approved, and that can be another trigger. And third is, this concern over, Obamacare being repealed and so on and so forth is also now more or less behind us. So from here on, it makes sense to start re-looking at these sectors and some of the stocks, and that is what our strategy has been. In terms of IT, again, there have been a lot of headwinds with the visa issue and, obviously the rhetorics by the new US president over sort of powering the fundamentals. There is obviously slower growth compared to what the sector used to report earlier. However, again, stocks are quite attractive, and after a long time you have IT as a sector enjoying a PE which is much lower than the market. It's a decent sector, but obviously with lower growth, and at some price point it might be a sector where you can make maybe a 12 to 15% return for at least a few more years to come. So I think they are sectors worth keeping an eye on, but at this point we are not overly overweight on them.
So that takes care of our global and domestic outlook. So at the current levels, you think that the investors should opt for lump sum, or should we continue with our SIPs?
See, for a retail investor, obviously SIP is the best thing to happen. A lot of people refer it to the 8th wonder, 9th wonder, or whatever it is. But we have seen over the last 3-4 years, and maybe even longer, investors who have constantly but regularly kept on investing through the systematic investment mode have been enjoying peace and also good returns. So I think that should be the preferred mode going forward also.
Thank you so much, sir. This really helps us a lot for making an investment decision. So, sir, wishing you a very, very happy financial year ahead. Hoping the new financial year brings in lot of happiness and bounteous wealth creation for all of us.
Thank you.
Viewers may please ask their questions or email it to us or follow us on Twitter. The details are right on your screen. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.